Hi, I'm Bill Spaulding. Welcome to WCS Money Tutorials. A tremendous bull market for bonds is coming. This video will show you how to get a high yield with no reinvestment risk, how to earn the maximum capital gains, and how to use long-term options to increase those gains even more. There is always some risk to investing, but investing in bonds now is the best way to earn both high interest and substantial capital gains, all for very little risk. This video will cover how bond prices are affected by interest rates and how duration measures that sensitivity. I will also discuss the state of the bond market now and why I believe bond prices will soon rise substantially. Then I will discuss the best securities to buy, including long-term options to benefit from the coming bull market in bonds. To understand the basis for the recommendations in this video, I will first discuss bond prices and duration. To understand duration, you must understand how bond prices are determined. The value of the bond equals the present value of coupon payments plus the present value of the par value, which is received when the bond matures. Present value depends on interest rates. Therefore, bond prices also depend on interest rates. The price of bonds move inversely to interest rates. When interest rates rise, bond prices decline, and vice versa. Learn more about bond prices and yields and about present value and future value in my video about this subject. The link is provided in the description below. Duration measures the interest rate sensitivity of bonds. When interest rates are low, a longer duration means greater interest rate risk, because when interest rates rise, then bond prices will decline more for long duration bonds than for short duration bonds. By contrast, when interest rates are high, a longer duration means that there is a greater potential for capital gains. And, as you know, most people now believe that interest rates are at their peak. Interest rates are expected to decline as the economy slows. Graphically, the duration of a bond can be envisioned as a fulcrum placed under a seesaw so as to balance the weights of the present values of the coupon payments and the principal payment. This graph shows the greater interest rate sensitivity of long-term bonds over short-term bonds. The curve for the 10-year bond is steeper than the curve for the 3-year bond, which means it varies in price more as interest rates change. You can see how bond prices and duration interact by observing the change of prices of these three Vanguard ETFs, based on U.S. Treasuries with different terms and durations. Note that the three ETFs were affected similarly when interest rates changed from 2018 to 2022. But the ETF based on long-term Treasuries changed in price by a much larger percentage, even though interest rates changed by only 2%. Thus, long-term Treasuries have greater price risk, but they also have much greater capital gains when interest rates decline, because they have the longest duration of these securities. Although there are formulas for calculating duration, you can simply look up the duration of any security by viewing the information provided by issuers and by brokers. To find the duration for securities offered by brokers, you must click to deeper levels on the type of security you're interested in. So, for instance, if you want to find the duration for a 30-year Treasury bond in Fidelity, then click on the appropriate link. Then click on the type of bond that you're interested in. Then click on Price and Performance. Here is where you will find the information on duration. The best way to take advantage of the coming bull market of bonds is by investing in exchange-traded funds holding U.S. Treasury strips with the longest duration. I have listed a few examples here, but I will discuss more about them later. Although other types of bonds with long duration have capital gain potential, these other securities have disadvantages. The market for individual bonds is highly fractured, so individual bonds have low liquidity. Many bonds are also callable, which greatly reduces their capital gain potential. And they have significant reinvestment risk because they are more likely to be called when interest rates are declining. Individual bonds also require higher minimum purchases of at least $1,000 or more. Corporate bonds may also have significant credit risk. The problem with corporate bonds is that interest rates usually decline when the economy is slowing, so some corporations may experience financial distress. Default rates usually increase, especially if the companies were forced to issue debt or borrow money at high interest rates, which further increases the likelihood they will default. I want to emphasize avoid callable bonds, which are bonds that can be redeemed by the issuer if interest rates drop. Because if interest rates do drop, those bonds will be called, so you will not benefit from any capital gain potential, since that will only occur after interest rates drop. Information provided by insurers and brokers will state whether the bonds are callable. Among treasuries, 30-year treasury bonds, 30-year TIPS, and long-term strips have the longest duration, so these treasuries have the greatest potential for capital gains. You can now also earn pretty good interest from treasury bonds and TIPS, but Treasury strips do not pay any interest since they are zero-coupon bonds. The main problem with Treasuries is that the market is highly fractured, and prices often vary with the quantity being purchased. Therefore, most people prefer to deal with exchange-traded funds based on U.S. Treasuries because they are much easier to buy and sell. The 3 ETFs based on U.S. Treasuries with the longest duration are displayed here. These ETFs are based on Treasury strips, which are carefully chosen to provide the longest duration. You can see they are highly correlated. However, I will focus on EDV since it has the most liquidity, but the principles I explained in this video apply to these other securities as well. There are also several ETFs that hold Treasury bonds. While the duration of these ETFs is long, it is not as long as the ETFs holding Treasury strips. For instance, this graph shows how EDV compares with the iShares Treasury Bond ETF. Because EDV has a longer duration, its price increases more when interest rates decline, and declines more when interest rates rise, compared to TLT. One of the major benefits of U.S. Treasuries, or ETFs based on U.S. Treasuries, is the flight to safety, also called the flight to quality, that sometimes occurs when there is turmoil in the world. In such cases, these securities zoom in price as people sell riskier assets to buy safer assets based on U.S. Treasuries. Here, you can see that EDV, which is based on U.S. Treasuries, did much better than ETFs based on corporate bonds during the start of the COVID-19 pandemic in 2020. There was also a recent spike when Hamas attacked Israel, though the spike was brief. Bigger spikes may occur if China attacks Taiwan, or if there is another pandemic. Some people are worried about the recent credit downgrades for the United States government by the major credit reporting agencies. Although United States debt has been downgraded, the credit rating of the United States is still much higher than most other countries. There is no doubt that the United States will continue paying its bills, even if some of those payments may be delayed by a shutdown, which is unlikely. Without a pristine credit rating, taxes would have to increase substantially to pay for higher interest rates if there was any doubt about the creditworthiness of the United States, a result that both Democrats and Republicans want to avoid. Another popular bond that many people are buying is the Series I savings bonds. While I bonds do pay a good interest rate, they cannot be sold. They can only be redeemed by the government. That eliminates interest rate risk, but it also eliminates any capital gain potential. Check out my previous video on long-duration securities, which goes into a much greater depth on the best securities to own to maximize profits of both interest and capital gains. The link is provided in the description. The bull market for bonds has already started, and will probably continue for the next 2 years, at least. Why? There is strong evidence that inflation is continuing to decline. Many investors now believe that interest rates have peaked. Jobless claims are rising, both an indicator and a cause of a slowing economy. Oil prices are declining, which affects the prices of many other goods and services. The market is now projecting a 0.75% reduction in the federal funds rate by the end of 2024. If inflation continues to decline, then I believe that EDV will reach the 90s by May 2024. I believe inflation will be a lot lower by then, and that the economy will be slowing significantly from the high interest rates. With the economy slowing, many investors will expect the Federal Reserve to start decreasing interest rates. Indeed, the Fed may feel pressured to reduce interest rates because of the presidential election in 2024. Thus, investors will start buying up long-term bonds to reduce reinvestment risk and to profit from capital gains. Another major factor propelling bond prices upward is that the federal government will be issuing less debt in April, since that is when it receives most of its tax revenue. This will put upward pressure on long-term bond prices. If you look at this graph, you can see that EDV was doing pretty well last April. Now, to be clear, this does not mean that this will happen again, but usually when supply is restricted, prices rise. The price declined so much from July to November because the federal government was issuing so much debt to pay its bills. Needless to say, the government will still have to issue ever-increasing amounts of debt to finance its future, until Congress does something about it. But at least in April, it will receive significant tax revenue, which should lower the amount of debt being issued, at least for a while. You may benefit immensely from the coming bull market in bonds by investing in long-term options. Now, I want to point out that the availability of options and their prices changes with time, but I want to give you an idea of what is available and how much you may be able to profit. EDV is the most liquid of the long-duration securities, so it has more options available. The longest-term options available as of this recording are the May 17, 2024 options. I have invested in calls with strike prices of at least $80 because I think these options are reasonably priced and I think they have a strong likelihood of going into the money. There are also options for ZROZ, but there were far fewer strike prices available when I last looked. The same for GOVZ. I will do a more extensive video on options, but this video is not about options, and I am assuming that you have some knowledge of options. But here is a very simple example of how you can profit. If you buy a call for $1 on EDV with a strike price of $80, and the call expires on May 17, 2024, then your maximum loss is $100 plus a small commission. If the price of EDV goes to $90 before expiration, then the option is worth $1,000, giving you a total profit of $900 minus a small commission. If the price of EDV stays below $80 per share by expiration, then the option expires worthless, unless you resell it before expiration. But your maximum loss is the premium paid for the option, plus a small commission. There is some risk with options, but if you do it wisely, you can easily limit your risk. So if you buy a call for $100, then you cannot lose any more than $100. The decision is yours. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thismatter.com for more than 850 in-depth fundamental tutorials in personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.